Hello and welcome to our Why and How to Invest in Gold webinar. I'm Andrew Seekus, Global Head of Content for Minds and Money, and today I'm joined by three leading London fund managers, all of whom run successful gold and precious metal funds. We are joined by Angelos Damaskos, Chief Executive Officer for Sector Investment Managers. Angelos is an experienced fund manager with over 16 years experience. In September 2009, he launched the Junior Gold Fund, which invests in smaller gold and silver mining companies in safe political territories. Keith Watson, portfolio manager for Seekus, is a co-fund manager for Seekus's Natural Resources Growth and Income PLC, Geiger Counter, and Golden Prospect Precious Metals. And last but by no means least, we are joined by Ian Williams, Chairman and Chief Executive of Charteris. Ian started his career in 1975. He is currently the Chairman and CEO of Charteris Treasury Portfolio Managers. His Gold and Precious Fund was the best performing fund in the UK across all sectors in 2016. Welcome to my three panelists, and also welcome to all of those who are dialing in. The webinar is scheduled to run for 45 minutes. A couple of housekeeping comments before we start. All registrants will receive a copy of the recording of this seminar via email. You can ask questions at any time using the questions tab in the GoToWebinar panel on your screen. And if you experience any trouble with sound, we recommend that you exit the webinar and then log back in again. We'll also be taking questions from the audience as well as running our interactive polling throughout the session. To ask any questions, just use the questions tab in the GoToWebinar on your screen. So perhaps I can start off with an opening question. Perhaps I can ask the three of you, probably starting with Angelos first, just to briefly introduce your gold and precious metals fund that you run.
Thank you, Andrew. As you intimated earlier, we launched Junior Gold Fund in September 2009 in the aftermath of the financial crisis. As we saw that mining equities, precious metals mining equities were oversold, and there was a big valuation gap with where the commodity was trading and the valuation of those companies. We have chosen to invest in the smaller capitalization companies, and that means, unfortunately, that we have the most volatility in the fund segment. And that can be a good and a bad thing. Obviously, it is good in times of a positive market sentiment environment when investors are looking to take advantage of rising precious metal prices and invest in the growth companies, which are typically the smaller single asset or early stage companies. You know, obviously, when the market turns negative, we suffer from lack of liquidity and poor sentiment. So it is a much more volatile product, but it appeals to those investors that have a medium to long-term view about precious metal prices and the likely outperformance the smaller growth companies can offer.
Okay. Keith, can you tell us a little bit about Seekus's fund?
Yes, Seekus is the umbrella company behind the Golden Prospect Precious Metals Fund, which is a closed-end UK-listed entity, which also invests in what we see as the best area to allocate longer to medium-term money in the value end, which is certainly very much the case of smaller cap precious metal mining equities at the moment.
And Ian, can you just tell us a little bit about Charteris funds?
Okay, it's a UK UCITS fund. It's an OIC. It has daily dealing. It's open. It's not closed end. It slightly differs from Angelos' fund, is that we tend to concentrate on the mid-tier space. We don't really buy the exploration shares, but equally we don't like the large companies like Barrick. So our fund is exclusively or almost exclusively concentrated on the mid-tier sector, where you don't have these problems of illiquidity. And also the fund has a very high weighting exposure to silver mines as opposed to gold mines. But it's 100% in gold or silver, well, one palladium producer. But it does have a very high exposure to silver mines.
Okay.
That's where
so Ian,
come from.
Okay.
Sorry.
So that's it's going to be interesting. We've got three fund managers with very different sort of portfolios, very different strategies. But perhaps then I can sort of ask you the sort of like next question, which is why should an investor have gold in their portfolio?
Well, the obvious question, the obvious answer to that question is diversification. I mean, funnily enough, we run other funds as well, and we spent a whole morning looking at individual shares just in the UK. Big leading companies, ranging across all sectors. And it's just amazing how many have spent the last 5 years just doing nothing but go down. And you don't necessarily gain this just by looking at where the FTSE's gone. But the individual components, there's been some absolute horrors in there, and a lot of them across all sectors. Whereas the gold shares, although they haven't, there's not been much excitement in the sector, they haven't actually gone down like a lot of the other shares. It's remarkable. Of course, the stars of one of the stars of the certainly in the UK mining industry, the FTSE, is all Rio Tintos and BHP Billitons are all hitting multi-year highs, which is one of the reasons the FTSE has held up so well. It's been the performance of the mining sector. So we think that what you've seen in the big cap BHPs and Rios in the base metals, iron ore and stuff, we think it's going to trickle over to the precious metals sector at some stage. The whole thing has a slightly different feel now than it's had for the last 2 or 3 years. It actually feels like it wants to go up.
Mm-hmm. Okay. So I guess that moves on to the next question, and a question for yourself, Keith. How has gold performed as an investment over time?
That's a very broad question, and it depends how far back you tend to look. I would say that it goes through periods of being a very strong performer. It just depends on when you start. But if you looked at, say, the post-Bretton Woods period, it's been exceptionally good, with some relative outperformances against other asset classes, the post-war period and the post-1980s period in particular. I would say that on a more meaningful investment time horizon of, say, 5 years, it's actually been quite steady, plus or minus a trading range of about $100 or so. I would say, and coming back to your earlier question at the moment, that unlike previous cycles, I think we've moved from something like a business cycle driven market to being much more driven by monetary cycles. Debt is very high, interest rates are low. We look at bonds in Europe, they're minus 30 basis points, and things are different now to the situation they were. I still think very sensitive to politics, to minor moves in the underlying business cycles. And when we look at things like global policy uncertainty indices, which you can find on data feeds like Bloomberg, now is very definitely probably a time to look at an asset which I think has been left out in the cold. And again, comes back to an earlier comment, I think it's very useful in these times to have some form of diversification in the portfolio. So right now, whilst it's lagged things like the S&P quite substantially, as the monetary cycle of the rounds 1, 2, and maybe more of QE have kicked in, I think now gold is certainly a sector that should be considered, and is, I think, more relevantly to how it has performed, how will it perform. I think it would be wise to start to allocate to it, because it's such a small portion of the liabilities that are currently out globally. And now could just be a time where, having lagged, it's going to perform.
Okay, so that's very interesting, and we just had our first question sort of sent in, which actually corresponds on quite similar lines to the next question that I was going to ask to yourself, Angelos. So the question in was like, should I be buying gold now? So is now the right time to buy gold? What factors should one consider when investing in gold?
Yes, first of all, I would echo the comments of my co-panelists and say that I believe that every well-diversified portfolio should always have an allocation in gold and gold mining equities, because the function of gold as a safe haven works best over the long term and has proven its worth in the recent financial crisis and recessions. However, I believe strongly that now is a particularly important time to increase allocations to gold, due to the elevated monetary and economic risks we are facing that could induce turbulence in the financial markets. We saw that happen in the last quarter of last year, 2018, when gold actually decoupled from its inverse correlation to the US dollar and rose with it in response to the market correcting. If we have a repeat of a financial scare, we could see gold rise as more investors tend to safe havens. Furthermore, there are also elevated geopolitical risks that the world is facing at the moment that could spark conflict without any notice and cause a derating of risky assets. And again, gold is likely to play the safe haven function and rise in value. The most important factor, I believe, to consider when investing in gold is the time horizon an investor is willing to bear, so that one is not pressed to access invested capital at the wrong time, that is before the crisis happens and gold really proves its worth as a hedge.
Okay, so I think that probably leads on to our first polling question. So if we have the first polling question up on the screen, and then just for those of you who are dialing into the webinar, you're just please, we just encourage you all to go and vote. So the question for you is, what's the best way of investing into gold? We've got a number of options there: equity in gold mining majors and mid-tier companies, equity in exploration companies and junior producers, investing into royalty and streaming companies, gold equity ETFs, or gold commodity ETFs. So perhaps if you can just go and, obviously sort of fill in your sort of answer there, and then we're going to be sharing those results with you later on during the webinar. Let's kind of move on to the next question. The next question is for yourself, Ian. What advice would you give to a retail investor who was evaluating what type of gold investment to make? I know you've talked about sort of like diversification in your sort of like an earlier answer, but perhaps you can just go into a little bit more detail.
Okay, well, most investors all around the world don't have virtually no exposure to gold or gold mining shares at the moment. And I think there's several possibilities that are going to bring a bit of life back to this sector. So I think, funnily enough, it's always strange off the radar things that might trigger this. And I think that the trigger to really get investors excited about gold, funnily enough, is a spillover from Trump and his putting sanctions on major countries all over the world. Because there's a lot of talk that the Russians and the Chinese are working on a gold-backed crypto. Now, if they do that, it's a great way of getting around US economic sanctions. So there's obvious reasons why they're doing it. The Chinese do it, the Russians do it, the Iranians will want to clamor more. There's a whole lot, Indians probably as well, or anybody who's feeling the wrath of Trump and his sanctions everywhere. Because these sanctions only have, under US law, if the trade takes place in US dollars, because the US dollars clear through the US banking system. If they can trade without going through the US banking system, they can't be subject to US sanctions. There's nothing that Americans can do about it. There's a major driving force. And I think the way the global monetary system is being reset, it's going to have some modern technology with crypto coins. The Russians apparently are in the forefront of having a gold-backed crypto. Now, if they bring that out and it starts going live, that's going to trigger enormous interest back in this sector, which is dead. So, like all these things, you need a catalyst to wake it up, and I think that's what the catalyst is going to be.
Okay, that almost like leads into like the next question that's just been sent in to us, which is what are the pros and cons of investing into gold-backed cryptocurrencies? I don't know if any of our panelists would like to take a stab at answering that.
I'm happy to answer this question because I feel particularly strongly about various issues that are thrown around and marketed as cryptocurrencies, which in fact are not crypto at all. First of all, any investor wishing to buy some of the well-known gold-backed so-called cryptocurrencies would have to register with a broker and give their entire details, know your client details, etc. So the crypto sort of designation falls away, and really is something that relies on the value of gold. So it might be a competitive product to gold-backed ETFs, but that's all it is. So it's different to what Ian suggested earlier about a nation launching a gold-backed way to trade commodities or other goods, such as Russia or China or whoever. But for cryptocurrencies as such that are accessible to investors to gain exposure to gold bullion prices, the products that I have seen in the marketplace are nothing more than a differently named ETF.
Okay. And now on to our next question. Obviously, there's a lot of interest in investing into gold mining equities at the moment. Keith, in your opinion, which gold mining equities have delivered the best performance over the last 6 months?
I would say over the last 6 months, which is a relatively short period of time, we've had a bit of a catch-up of the value names that certainly that we have looked at. I'd say the majority of those are small cap, and I think the majority of those as well have been with assets domiciled in jurisdictions where the currency has depreciated, and in particular I would point to companies based in Australia. We'd previously seen some very strong performances from Australian, what I would call large caps now, the Northern Stars and the likes. Our focus has tended to be in the smaller cap end of the spectrum, and those have, as I say, played catch up with companies such as Dore, which did a merger of equals with Silver Lake, being one of the top performers over that period, and is one that we were, I think, lucky enough to be involved with prior to that merger via Dore. And I think we would hope, even though it's a 1+1 is currently something nearer a 4 as a result, it still has some way to go in order to normalize with, at current spot prices, the price to NAVs of some of those larger peers such as Northern Star. Elsewhere, I would say that it was mentioned by Ian that they are looking at silver. That typically is the more volatile cousin of gold, and I'd say that we would be looking at hopefully rotating some of the gold performers that we've seen into perhaps that area of the market, which might well be a beneficiary of some, I think, continued gold price performances whilst it's currently over, say, the halfway mark of the trading range it's been in. I think most of the short-term indicators, whether or not you just look simply at the implied US rates that are being carefully watched at the moment, or even sort of put call spreads and skews, then we would say that there's a good chance that the gold price could move towards the top end of that plus or minus $125 range that we've seen over the last 5 years, and silver could well be a more leveraged way to play that. I'd say, though, coming back to it, that it's been the M&A sector as a theme which I think has benefited the undervaluation of the junior miners, where we, as a closed-end fund, have an appropriate remit to invest, with stickier money being able to take some of the liquidity issues that would otherwise be associated with that. That's where we see it. So we've had a currency benefit and some M&A on top, which have delivered some very strong returns for particular entities.
Mm-hmm. It's interesting that in your answer you mentioned both M&A and you also mentioned sort of silver as well. I'd probably just like to ask a question to Ian, because I know that Ian, you, historically you've been a strong advocate of silver. What, in your opinion, is the kind of the price relationship between silver and gold, and what do you expect the gold-silver ratio to be at by the end of this year?
Well, the gold-silver ratio at the moment is around 90, which is knocking on its all-time high. Now, usually when it gets up there, it's normally a reasonably accurate indicator that the entire precious metals complex is a buy. There's a very much directional bias built into the way that ratio works. So what you find in a traditional bull market is gold nearly always moves first. So in a traditional precious metals cycle, gold will start going up and silver will be not doing anything, which pushes the ratio up and up and up, which is what's happening at the moment. And then if the bull market in gold continues, all of a sudden, after a few months delay, silver suddenly kicks in. And then the volatility of silver is probably triple what it is in gold. So we always say that if you believe, investors, any investors believe that this is a bull market in precious metals, you'll make far more money out of silver mining shares than you will out of gold mining shares. That's not to say you won't make money out of gold mining shares. You'll just make a lot more in silver miners.
Okay. Just a question for yourself, Angelos. Obviously, in the key stance, he talked a bit about the current sort of mega mergers and consolidation taking sort of place. What do you make of that amongst major gold miners? Do you think that this will spill over to smaller gold mining companies?
Yes, most certainly. I see the recent mega mergers we have seen between Randgold and Barrick and Newmont and Goldcorp as defensive practice. After years of bear market and weak gold prices, management teams really struggle to survive, and they have been battered, so to speak, into submission. And not really believing in a much higher commodity environment. So we see from these merged groups that they concentrate on housekeeping, reducing costs, overheads, and managing their asset base, i.e. selling assets that they believe are non-core and not worthy of focusing on. And in organic growth rather than ambitious growth by acquisition. Effectively, it's the result of the industry being the price taker for the commodity, and the confidence of management teams being battered after all these years of mediocre prices. Ultimately, a rising gold price will force management teams to look at future growth and the reserve replenishment ratios, and therefore it's always dependent on how quickly, of course, the prices rise for the commodity. But ultimately, they will be forced to buy smaller companies that control growth assets, as this is always a quicker way to grow your production and reserves than exploration, drilling, and development in-house. So I think most certainly it will spill over to the smaller companies. And the question is when, and will be a function of how quickly the commodity prices rise.
Okay. Moving on to our next question. We've talked in brief about gold equity ETFs. Question also to you as well, Angelos. Would you kind of recommend gold equity ETFs to an investor? Can you talk a little bit about their popularity?
Yes, I mean, ETFs have exploded in popularity in general across all sectors and industries in the last few years. And I believe this has been, the main driving force has been the massive amount of liquidity in the markets and investors trying to allocate their portfolios, not really having the ability or time and resources to analyze and scrutinize the portfolio construction. So as most asset classes have re-rated due to the quantitative easing, there has been a tendency to allocate widely across asset classes, and ETFs are seen as a low-cost way to access certain sectors in a diversified manner, without necessarily taking the company-specific risk. However, after several years of growth, I believe that it's becoming apparent that the ETF products have become too large, and they are actually underperforming the indices or the subsectors they are designed to track. Therefore, I strongly think that specialist active managers will start growing again in popularity as investors try to be much more laser focused and scrutinize the performance of their portfolios. So gold ETFs have been a very popular vehicle, particularly for bullion-backed ETFs. It is a good way to gain access to to gain exposure to the price of gold bullion without storing bars in a safety deposit. For gold equities, it is a rather passive way of gaining exposure, and now most of the gold mining equities ETF products are heavily weighed towards the larger capitalization mining groups. And therefore, in a broader bull market in our sector, they are likely to underperform.
Okay. So
I would have to say, if I may step in there, if I stepped in there, I would completely back Angelos on that. In our experience, and I think particularly since the cycle of quantitative easing as a monetary policy began, then we've seen some very clear trends in the number of shares out of ETF strategies more broadly, but particularly so with both bullion-backed and the larger US-quoted GDX and GDXJ. And I think it's quite telling that the liquidity that I think has been pumped into the system as a result of QE has come with its own inherent liquidity requirements, to the extent that passive investment as a style has very much come to the fore with those trends on shares out in the ETFs, I think, proving it. When we look at the relative value within that, I think that has similarly created a disparity between the liquid larger names and the forgotten smaller cap names, which I guess is something for investors to consider how they want to play it, depending on their risk appetite. But I think that's worth noting.
Thank you, Keith. I think we should now sort of move on to our next poll, which is our second poll of the webinar, which is, where will gold be at the end of 2019? So there's 5 options there. There's either below 1,280, between 1,280 and 1,359, 1,360 to 1,499, 1,500 to 1,999, or 2,000 and above. So if you'd like to go and vote now. And whilst we're allowing the webinar participants to vote, perhaps Angelos, let's go and put you on the spot. Where will the price of gold be by the end of the year, and why?
Well, I have learned from experience that it's a fool's game trying to predict commodity prices in the short term. Having said that, I am willing to be the fool at the moment that predicts that we are likely to see $1,450 per ounce this year. And I have grown more bullish in gold this year, having seen the massive rise in buying by the Russians, the Chinese, the Turkish, and other central banks over the past year or so. In my view, these are long-term holders as they use gold to support their national reserves, and therefore their actions remove gold that can be freely traded and delivered in the market. So when, for whatever is the trigger for a flight to safety, financial investors increase their allocation to bullion and gold-backed ETFs, there could potentially be a rush that would push the price of gold up very quickly. I think we have seen some dark clouds over the economy recently. The polls, there is a very interesting poll conducted by JP Morgan that indicates that more than 30% of active fund managers have some sort of a hedge against the markets falling, and also that the probability of recession over the next year or so has risen to about 30%, which is the levels we saw before the main financial crisis of recent years, for example, in 2007. And under these circumstances, it is likely we will have volatility in the markets and a risk-off attitude and a flight to safety. And I think under these circumstances, gold is likely to outperform all other asset classes and reach much higher levels than it is. But I think it is fairly realistic to expect to see 1450 by year end.
Okay. Turning to Keith, how should you factor in the price of gold when making an investment?
At the moment, I think we would take the view that cash is very much king, and we would typically look at those companies that will be mines, even if there were a price decline. Ideally, with the flexibility to manage costs and therefore cash flow, should prices disappoint and dip to, say, even $1,000, technically that can also happen. Though I think to come back to Angelos, who was put on the spot, if we look at things now, I don't think that's necessarily the immediate driver. As I said, I think the put-call skew is probably more favourably positioned, and with the prospect of a cycle of monetary policy loosening, and certainly without a resolution to the trade war, which is quite a big caveat, we could easily see the price over 1400 before the year end. But I think we would still tend to bias our portfolio towards those companies that we feel have that flexibility from an operating standpoint to adjust the grade that they mine, or have sufficient balance sheet funding to be able to see themselves through a brief period of the gold price should it take a dip to even $1,000 US an ounce. That's our general approach, just to make that clear.
Ian, in terms of the price of gold, there's a number of very strong gold advocates, gold bugs out there. Examples include the next financial meltdown will see gold rocket up to $5,000 that will end up reverting to a gold standard. In your opinion, are there any sort of merits to the sort of like gold bug investment thesis?
One thing that no one's discussed yet is the last 2-3 years, gold's been in a headwind of the Federal Reserve raising interest rates and the US dollar being the strongest currency in the world and gold being priced in dollars. It's obviously, as mentioned before, if you look at it in Aussie dollars, it's an all-time high. We're now entering a cycle where the Fed's going to start cutting rates and the dollar potentially is going to go from a very strong currency to a very weak currency. Now, that on its own will be sufficient to push gold up to between 1,500 and 2,000 because it's just the mirror image of the dollar going down. Gold's done incredibly well to hold where it is in dollars, bearing in mind how strong the dollar's been over the last 3 years. Whether it goes to 5,000 or not, it's not going to go there this year, and it's probably not going to go there for another 2 or 3 years. But if you look at these commodity cycles, and the way commodities tend to trade, they do tend, when they get going, to go up in rather large amounts. I mean, silver could easily, gold's not too far up its all-time high. The silver to get to the same all-time high, it's got to triple in price. So these figures like 5,000 look crazy at the moment. There's no catalyst or anything to get it going. But you throw all these things like Russian gold, crypto, weak dollar, also they all, they all come together. You could easily see it up around its all-time high, 2,000, but it'll take several years, I would guess, for it to get to 5,000 if it does at all.
Okay, so I think that kind of like leads into our final sort of like polling question, which is what's the main reason to hold gold? We listed a number of reasons on there. Gold holds its value over time, the weakness of the US dollar as a hedge against inflation, geopolitical uncertainty, or as been mentioned earlier by Ian and a number of other panelists, portfolio diversification. So perhaps if you can obviously enter what your sort of choice is, and again, we'll go and share those results later on. We've talked so far about, I guess, many of the positive reasons for holding gold, but gold, as with any sort of like asset class, there are certain sort of risks. Keith, in your sort of opinion, what are the sort of potential risks or downsides of investing in gold, which our sort of listeners need to be aware of?
I think in the short term, you just have to keep an eye on some of the rather blunt politics that are at play. And if, for example, a trade deal were to be negotiated between the US and China, then I wouldn't be at all surprised if the marginal money goes back to risk on assets and everything's back to normal. In which case there's the chance that the gold price could come back down. I would say, though, that the gold equities have been far less responsive to the prospect of a monetary loosening stance as we see a lot of them performing. Yes, we've had a little bit of a pickup of late, but that's still, I think, less than would be we would expect given the underlying gold price move. So there might be some insulating factors to actually holding gold equities within any allocation from an investor. That's as we see it. Longer term, I think we probably just have to be slightly careful for the world we wish for if we're a gold bug. If the gold price is tomorrow $5,000, then it's probably not a very nice one, and you'd probably be as well to split whatever money you've got into 1 gram coins and hide those under your bed for and stockpile whatever you need. I don't think we're quite at that point yet, but it is a tail risk nevertheless, and I would just say that that's probably the main risk, that geopolitics manages to sort itself out. But it's still very difficult to see how long the government backing is able, in China's case, to sustain fiscal stimulus, or the monetary policy in the US to drop rates to, some new theoretical basis. And, the outcomes of those are very uncertain, and it does feel very much like it's just to kick the can down the road in any event.
Mm-hmm. So that kind of leads into a question that's been sent in, and perhaps I can perhaps ask it to yourself, Angelos. How is the US-China trade war impacting your investment decisions at the moment?
Well, it has nothing to do with, if I concentrate on my investment decisions in the gold space and disregard, any investments in the other sectors of the economy, I don't have any influence on the, other than a potentially positive outcome for the gold price out of the trade wars, i.e. if the trade wars continue, and it is very likely that there will be some kind of a break on economic growth, therefore impacting financial markets, therefore causing a flight to safety by investors and pushing the value of precious metals higher. So it doesn't necessarily impact the investment decisions within the gold space, but it gives us more confidence about the outlook for gold and gold mining companies.
Okay, and then in terms of, can you just talk a little bit about how do you actually generate investment ideas, Angelos, and just decide as to which the markets to primarily focus on?
Sure, sure. Like my fellow panelists, we are specialists in the gold mining space, and we are known very well in the marketplace as such through our years of exposure. So we are in the good position to be approached by most issuers, especially smaller capitalization companies, as well as most intermediaries. So we get to see a very large number of situations and opportunities to invest through private placings as well as in the market. And our network of contacts ensures that we have a fairly good deal flow. We also attend specialist events, among which Mines and Money is the preeminent mining event in the London calendar. And we get to know some of the new entrants and other names that we haven't met before. So by keeping contact, a close contact to the marketplace as specialists, it ensures we have, we keep building on our extensive database, which helps us screen and rank opportunities. As I said, our concept is to focus on the smaller capitalization companies that control the growth assets of the future. And we like to concentrate on those that are most economic and probably quickest to come to production under the right circumstances.
Okay. Thank you very much for that, Angelos. I think we've got time for a couple more questions. Keith, Ian Telford said that we'd gone past peak gold production last year. Do you agree, and what do you think of peak gold theory?
If we haven't, it's quite possible that we're very close to it. I would say that would be helpful from a supply side, but I think the real driver to this, I mean, is still the immaterial or the very low value of gold to outstanding liabilities elsewhere has been a far more important driver to the gold price than just the short-term supply side of that equation. Helpful, but I think the more meaningful factors are, what is the dollar doing? How do people value US treasuries? And, how much confidence do they have in further momentum in the alternative investments that are out there, such as, for example, global equity markets, perhaps the likes of the S&P has been the most obvious proxy. And I would say that, just to bring it full circle, some diversification here is a very worthwhile thought process if you can.
Okay, and then I guess we're just sort of running into the final sort of like last minute of the webinar. So perhaps I'll just ask the last question to Ian Williams. Ian, what is the best investment call that you've made in your illustrious career?
Okay, well, fortunately it's in writing, so it can't be disproved. But when gold was $250 an ounce, I did send out a research circular saying it was a massive buy, and it was going straight to $1,000 in a straight line. Unfortunately, I underestimated it, and it went to 2,000. But there you go.
Okay, that's right.
But when these assets go up, they're not like normal shares where they go up 10 or 20%. They go up by multiples of themselves. So it's anyway, that's the best call I've ever made, and it's in writing, so it's can be proved if necessary.
That sounds an absolutely fantastic call that you made there, Ian. I think that it's sort of like we've actually just run out of time. So I'd just like to thank once again Angelos Damaskos, Chief Executive Officer of Sector Investment Managers, Keith Watson, Portfolio Manager of CQS, and Ian Williams, Chairman and Chief Executive of Charteris. As I said at the start of the webinar, we'll obviously be sending you a recording of the webinar along with the polling question results afterwards. My name is Andrew Thake from Mines and Money. I hope that you've enjoyed this webinar, and if you'd like to attend our next webinar, it will be on July the 5th on the topic of rare earths and rare earths investing. Thank you very much for your time.